going to set the stage with integration versus whether or not we have some experimentation here, right? So in the past, the crypto digital asset space has been very siloed, right? So it's been kind of that thing on the side that some people are touching, some people are not. But nowadays, it's touching everything, right? It's in payments, it's in banking, it's in capital markets, and data centers. So we'll kick it off kind of to the panel at Hawk here. What in your view signals that we're at integration, not experimentation at this point in time?
Yeah, I'm happy to start. I think the signals are telling us it's here now. I think the signals from a legislation and regulation perspective are telling us that it's no longer experimentation, it's working its way through a legislative process. The utilization of stablecoins is telling us that the payment rails are there and it's being adopted. The valuation on stablecoins has doubled in the last 12 months, so I think that's another signal. And then you look at the acceleration and the utilization of the ETF markets. We have large US advised wealth platforms with trillions of dollars of assets under management, advising their clients that digital assets and crypto deserve a place in their portfolio to not just basis points, but full percentage points. And the ETF wrapper has proven that that is a phenomenal vehicle. So I think it's the experimentation era for those has passed, and the signals here for adoption and implementation. And the world of tokenization and real world asset tokenization, capital formation, that signal of experimentation, I think will quickly lead to an arrival signal versus an experimentation signal.
Yeah, and I think I would echo what Ed's saying. I think that you've seen several really good use cases, where there's extreme adoption with stablecoins. They're getting ingrained in so many different businesses. But I think also when I look at it, it's just the resources, right? So when we were kind of going through this over the last 10 years, there was a lot of fintech companies, digital asset companies, and then there was traditional financial institutions. Today, everybody's hiring the same people. They're all looking for the same type of data, the same type of evolution of what's the next good thing to be able to break through here, and how do you implement this, and how do you give the users of who you're serving what they want, right? And I think that use case is being driven where every financial institution today is considering digital assets or blockchain technology in some fashion. They're hiring significantly to be able to produce the data and the needs to service those customers. So to me, the kind of it's here today is they're building it, right? Yeah. It's happening, and it's happening across every different type of institution, whether it's traditional fintech, whether it's a payment rail, whether it's an investment bank. I think that all of those different factors are coming to play today.
Yeah, and just to add to that, we had to overcome a number of major hurdles. Mm-hmm. First, I think a major hurdle was the education gap. Secondly, we were faced with the Gary Gensler administration and his crypto overreach. And finally, we have a pro-crypto administration that's very supportive of the digital asset space. And so, Wall Street is taking a very close look at the amount of demand for some of the products that have come online. And let's not forget, Wall Street is a selling machine, and they will move to markets wherever there is demand and an opportunity to make money. On top of that, blockchain technology has also evolved to be very purpose-built. And so, there are blockchains, like the Hyperliquid ecosystem, for example, that are very performant and meet the needs of enterprises to have that large amount of pass-through and efficiency. And so we're moving in stages, and we're going to see the benefits of blockchain really come to life through instantaneous settlement, lower transaction fees, and 24/7 trading capabilities.
So I'm going to take the fun out of this. As a lawyer, I'll take the fun out of this discussion, right? I agree with everything everyone said, and there's certainly, from the representing tech companies, the advancement in technology and the rails, the on-off ramps are so much more advanced than they were even 2 years ago. Mm-hmm. I think the challenge that we're seeing, and I think you guys would agree, is that it's still very crypto native, and so the rails that TradFi is on and the regulation that's all built around is still in place. And so we're running into where blockchain is helping, and with settlement and speeding things up, we're sort of forcing this into an existing infrastructure that is already inefficient. And so it's slowing down, I think, some of the real value in the technology to be able to settle quickly and do all these great things. And so I think the message really is, it's a matter of degree. There's no question about it. We're advancing and we're in the adoption phase, but there's still a long way to go, right? We still have rulemaking to happen in the US. And I think we have to get to a point where it's not just crypto native, it is more of not just ETFs, but more of TradFi getting involved in investing in crypto on a sort of a more wide scale basis, not 10% of the world, but 100% of the rest of the world.
Yeah, it's no secret. Blockchain technology is here to stay. Banks are evaluating blockchain rails to improve cost, speed, and efficiency. These conversations are happening at the C-suite level. Product managers across all these financial institutions are having conversations, and they're looking to build a roadmap for the next phase. So it's not a matter of if, it's a matter of when can we integrate this technology into our core systems, and innovation is certainly driving demand.
Yeah, and I think to build off that point and maybe just stick with you real quick here, Sarman, is what types of crypto and fintech clients are banks now clamoring for, whereas 3, 4, 5 years ago, right, you're going to get a quick notice on a Friday that you got to pull all your funds, otherwise it's gone forever.
So the narrative certainly changed.
Yeah.
A few years ago, it was difficult for clients to get a banking relationship. Banks now are open to supporting the entire ecosystem. Exchanges, OTC desks, funds, miners, DATs, protocols, and foundations are some of the verticals within crypto banks are supporting, as long as it meets their risk criteria.
Mm-hmm. That's fair. And I guess one last point on that one, I guess, Bob, we'll jump to you real quick. From an insurance standpoint, right, what are some of the challenges you're kind of either still seeing or starting to see go away now that we're getting to more of this mature industry?
Yeah, I think one of the things that we've seen that's really good is the maturation of the custodians and kind of the reporting systems in the industry. So, 10 years ago, there weren't any SOC certified custodians that had, private key management lifecycle controls that are tested by, a third-party auditor, right? So today, the custody solutions, the reporting out of them, the risk associated with, custodying assets is at a completely different level from a regulatory and oversight perspective. That you have those things that you can utilize in an audit, as part of the process to get through somebody in this industry. I think things that are still to come, is the accounting guidance is still lagging a lot behind, what some people are doing in the industry. So I think that when you look at it, we've got the fair value standard now, but there's a lot of caveats as to what fits into that fair value standard, what gets kicked out of that fair value standard. I think revenue recognition is another hot topic for companies in this industry as to gross to net. How do you value digital assets received in revenue transactions? So there's still a lot to be done when you start talking about reporting this information and consuming it from an investor perspective and educating people about how do you interpret the results of these businesses. So it's moving in the right direction, and there's been a lot of advancement, but still a lot to fix there and a lot to work through.
Yeah, and maybe sticking with you there a minute as well, as we kind of talk about the fair value accounting, which was a great step in the right direction, going from the cost-less impairment. We've all written countless comment letters to get away from that. So now that we're in that the fair value accounting side of things, we're now seeing the next iteration of development in the entire industry from the digital asset treasury strategy side of things. So I guess the question for whomever wants to kind of kick this off, what do you guys are seeing that distinguishes a thoughtful digital asset treasury strategy from just like a speculative balance sheet play?
And I can start there. So the reason I think I'm pretty familiar with this is because Grayscale, as an asset manager, for our products that hold digital assets, we get paid in the underlying digital asset. So we are inherently long the asset. We know how to work with the asset from a custody, from a trading perspective. We know how to set up counterparties from a hedging or risk management perspective as well. And so some of the basics from a treasury perspective are now just applying themselves to an asset that, on a long-term basis, volatility is coming down, but a thoughtful treasury strategy has to balance the idea of what you're doing with the asset once you have it. So we accrue the asset onto our balance sheet. Other corporate enterprises are financing the purchase of that for their treasury. And then once it's on your balance sheet, where does that go from there? There's the short-term, long-term game of, well, I see value accretion, But to your point, there's 24/7 trading on this. And so if you're sitting there with a responsible risk management hat on and it's Sunday and credit spreads blow out because of a world event, you have a tool on your balance sheet in Bitcoin or another digital asset that can access a liquid market very quickly. You can then downshift on your assets that have markets closed, for example, a short duration ETF where you can't trade that on a Sunday. Digital assets becomes a really good tool for you to risk manage yourself in off-market hours. And I think the responsible strategy is just how you balance that long-term, short-term potential within your balance sheet management.
That's fair. And I think, Bill, real quick, I mean, as we're kind of talking about kind of, that treasury strategy side of things, what is that fair value concept that's, been of late or kind of come out recently? What does that do for companies that are looking to adopt that treasury strategy?
Yeah, so as you pointed out, the previous accounting treatment of subsequent measurement was pretty difficult for digital asset treasury companies to represent their holdings at the appropriate fair value amount. What we saw with MicroStrategy, for example, was after the guidance came out, they had a major reversal that hit the P&L. And that P&L was of substantial size that it allowed them to actually meet the criteria to be included in new indices. And so while they were included in some and weren't included in others, it encouraged new fund flows, more volatility to the name, as well as different investor profiles.
That's fair. And then, Simon, real quick to jump back to you, are banks ready for this, providing treasury services to companies with crypto-heavy balance sheets, or is it similar to kind of what we talked about before, they kind of shying away from it like they were with just cash in general a handful of years ago?
I mean, banks are open to supporting DATs from a fiat banking perspective. It's still a game in progress for the digital asset piece.
That's fair. Yeah, because again, it's a whole different payment rail standpoint. We're not just talking about the fiat side of things, and yeah, exactly. Bob, to jump back to you real quick, obviously the fair value aspect of this has a balance sheet impact and a P&L impact. What about the things you're not seeing on the face statements, right? The policies, the controls, and all of those that kind of go on the underlying side of those processes?
Yeah, I think I'll kind of bridge off of a little bit what was discussed earlier is that, from a balance sheet side, I think we're mostly there, right, from a fair value perspective, but there's still a lot of limitations to that, right? So if a related party has issued the token, you can't fair value it. So who are your investors in a company that's holding that asset? It can't be the right to receive another asset. So if you have a liquid staking token or a liquidity pool token, an LP token, can that be fair valued? Those may be still subject to cost less impairment. So there's still a lot of iterations of where you might have a liquid token that gets transferred into something that can't be fair valued under the current accounting standards. So I know that the FASB is still continuing to work through it. They're looking at whether cash and cash equivalents is the right description for a stable coin. So we hope to see some more iterations come out of that, and the fair value guidance continue to be refined to capture more and more ways that people are working with these tokens. But behind the scenes, in addition to the accounting for it, what Ed said is pretty rampant in this, is that you have to be able to value it, and you can value it any time, any day. So what is your close of the market? If you're doing an impairment model, what is the lowest price it's traded at? Those are way different pricing tools than you're used to with traditional assets. So the data behind it, the controls, how do you know that what you're reporting in your financial statements is accurate and complete information? So that's where there's a lot of service providers in the industry who are starting to accumulate that data. But it's still an area of where there's more work to be done there. And I think that's a reporting tool that'll continue to need to be built out. But that's one of the biggest struggles that we've seen as companies come in. The accounting guidance isn't exactly 100% clear yet. There's a lot of industry practice that's going to go through with all these IPOs this year, which has been great to see. You're going to start to see the SEC's viewpoint through commentary letters that they've issued and responses from these companies to kind of build out that accounting guidance. And from that, companies are going to have to shift to and say, okay, if I was reporting something net and now I have to go to gross, how do I pull in the data of what that adjustment is? Or if I'm recording it at fair value and now I need to impair it, how do I pull in the data of the lowest trade price after each lot acquired, right? So it's a little bit different of a data point. And in that comes a lot of internal controls. How are you getting the data? How do you know it's reliable and accurate? And then you're going to hand it over to somebody like myself as an auditor, and we're going to ask you a lot of questions about it and drill into it and pull the data ourselves to determine whether we agree with that. And that's really the issue that a lot of these companies face, is that that's not something that you typically have as much of a barrier in traditional finance, right? So that's more of a crypto native concept of when I say, where are your digital assets? And you say, well, they're at this custodian. I'm really asking you, where are they on the blockchain? Like, what address are they in? That's a little bit different than saying, okay, they're at my bank, from a cash account. So the layer of application of controls goes a little bit deeper there as you talk about digital assets and how you know that you're reporting the quantities and the values of those appropriately with an ever-changing kind of accounting model that goes to it.
Yeah, absolutely. I mean, the disclosure, I would say, has probably been the area that we've seen our clients struggle the most with, right? Especially if they're going from a private cadence to a public, or even just doing this for the first time, to have that fair value roll forward of, all right, what are my ins and outs? And not just it's an in, it's an out, it's what kind of ins and outs. Where are you pulling that information from? And especially if it's not just at Coinbase or it's not just there or there. It's the DeFi platforms, right? All right, well, this is all off-chain. How am I validating that aspect of things? So I'm sure you guys run into a plethora of challenges there of just validating what's even in those roll forwards too. You mentioned it a little bit from kind of the mining side of things. I wanted to kind of start talking about the high power computing and the infrastructure and the AI side of things, and connecting digital assets to AI, energy, and the capital intensive infrastructure. So mining used to be discussed as a niche crypto activity. Today it's increasingly framed as high performance computing and energy infrastructure. Is that a rebrand, or is that a true real shift?
Yeah, I mean, these companies are really running, they're basically technology companies, and they view themselves much more as just sort of a native crypto. I'm running a server for a blockchain. These are actually sophisticated companies that have infrastructure around the world that are basically running data centers. And if you look at, for example, you look at the Canton network and some of the biggest names in TradFi, they're actually running super validators for that. I mean, this is a much more sophisticated industry and business from a technical standpoint than it was, a few years ago. And even we were talking about digital asset treasury companies, and some of those companies even are viewing themselves and looking at themselves as technology companies. They're first and foremost, managing treasury, but they also have deployment strategies, staking. They're running validators. They're running super validators. They're entering into partnerships where they're deploying assets, and these partnership agreements look like tech agreements. They have all the same sort of markings of a tech agreement and a high stakes data center agreement, right? So absolutely, it's a much more sophisticated environment, and these companies are doing much more than they were a couple of years ago.
Yeah, and just to add on that, we've seen Bitcoin mining evolve tremendously over the years. No longer is the majority of the network hash rate being computed from a desktop computer at home. It's now being done by industrial scale players who are running application-specific hardware that is extremely efficient. And so, as we all know or have heard in the headlines, Bitcoin mining does use a lot of electricity. And so a lot of these industrial scale players have developed immense power portfolios. And with the breakout in AI, these Bitcoin miners are a natural fit in our view. Bitcoin mining can be thought as a high-performance compute.
Yeah, and I think there's, we do a lot of work with either pools and mining companies. So I'd say that from a digital asset mining company, it's interesting because, is AI infrastructure and data build out the same as digital asset mining? Some of the power needs and the business models are a little bit different. So it's not always a clean cut. If I'm mining for digital assets like Bitcoin or Zcash or something like that, can I just transition that over to an AI data center? Because generally speaking, some of the miners are, they're going to put power back out to the market if the price is too high. They're more price competitive, where a lot of the AI compute is more, they need to be on 24 hours a day, money's going into it, and that needs to be backed up. So, it's an interesting transition to see companies that have built that out. I think there's a lot of value, and we look at them kind of as energy companies today, as to how you kind of look at them and how they operate. And I think they're a little bit agnostic as to what they can do with their energy contract, right? But there may be some parameters as to where that's beneficial or not beneficial, whether you're mining Bitcoin and you're going to sell power back to the grid when it's too expensive, or you want to run an AI data center where it needs to be on all the time, 24 hours a day, and backed up in several different ways to keep your contract, right? So there's a little bit of a nuance there where it might not always be a one-to-one conversion ratio, but I know a lot of those companies already have the infrastructure and the capital at play to be very successful in some of the new frontier there.
Absolutely. And Bill, to jump back to you real quick, do you think that investors and lenders are viewing mining assets more like data centers than crypto businesses now? Is that kind of the shift that we're seeing?
Yeah, so I mean, we are seeing a pretty substantial gap in market valuations between Bitcoin mining companies and traditional data center companies. And Bitcoin miners, given that a lot of them have approved power capacity, are looking at that as a re-rate opportunity. And so a lot of them have been pivoting towards traditional data center operations, and pivoting that power towards AI HPC workloads in order to, boost their valuations. And ultimately, the companies that are able to secure attractive lease agreements will be the ones that are able to see the largest multiple expansion. And what do we mean by that? We mean partnerships with companies that have high credit quality, a low cost of capital to project financing. And so, a number of these companies have signed deals with hyperscalers like AWS and other neocloud providers like CoreWeave. And they've been able to increase their multiples from single digits on a forward-looking EBITDA basis to the mid-teens. And traditional data center companies are trading around 20 times at forward-looking adjusted EBITDA. So, there is a modest gap in valuations, and we think that that's reasonable because, these companies still need to execute and prove themselves out.
That's fair. So you are seeing kind of a little bit of a difference in kind of what traditional mining companies we've seen versus the high-powered computer AI data center play.
For sure, yeah.
Joe, I know you represent some miners and business operating validators on kind of the L1 side of things. How are they viewing their businesses at this point and their digital asset infrastructure maturity?
Yeah, I mean, these are technology companies, and they view themselves that way. Their investors are looking at them as technology companies, and they're building software, right? So they're not just running. A lot of these companies are not just running servers. They're building software around it. They're building infrastructure around it, and they may even be licensing it out to other third parties to use it. So it's a very different environment. It goes well beyond just data center and just mining, right? They're building out basically an entire ecosystem, again, including hardware and software.
So the next biggest topic that we've all been kind of discussing, I know we were starting to talk about it before we kind of came on here, is the regulatory momentum and namely the Genius Act, right? So wanted to kind of get all of your thoughts on that, but does the regulatory clarity today feel like a competitive advantage, or is it still more of a compliance cost?
I'm happy to start.
Yeah, go for it.
So just from a regulation perspective, if we think about where we are, Grayscale has been a pioneer working with regulators for the last decade. Fortunate enough to have shared some of those initiatives with my colleagues on the stage. And overall, we believe any clarity, no pun intended, or regulation is helpful and beneficial for the industry. And whether or not that's a tax on operating, I think depends on what portion of the value chain or what you want to bring and the business model that you service gets impacted by that regulation. So for example, Grayscale does not need regulatory clarity to do what we do. We feel very comfortable with our business model without it, but we think it's beneficial for the overall industry. And from an investment perspective, while it's important, what we feel they're actually underwriting is actually comfort with the volatility and the resiliency of the asset. And so what I mean by that is the conversations we're having with large allocators or other investors is not, well, if this regulation happens, does that open up this opportunity? They're already allocating. It's which tokens do I allocate to? What does my risk profile look like? What is the actual understanding of the utilization or the utility or the protocol that they want to invest in? And they're really underwriting market risk and volatility. And when we see this type of dynamic over the last 6 months, it actually builds resiliency. This was a retail-led infrastructure for a long period of time and adoption. And now that's moving toward an institutionalized framework, which is kind of different than what we've seen in the past, which is institutional-led and then retail follows. And so from a regulation perspective, I think it's some of those institutions and their investment committees that want to see how that plays out. But where we are now, like we started with, is, or the topic that we started with, is just miles from where we were even 24 months ago.
Yeah, and I would bridge off of that. I would say that from a U.S. domestic perspective, regulatory clarity is a very large competitive advantage because for a very long time, many companies were looking to build offshore to avoid some of the regulatory climate here. I remember Grayscale had to sue the SEC maybe to go through the ETF conversion process. Now we have the SEC and the CFTC talking to each other about who regulates which tokens, how do we regulate the tokens, what is a commodity, what is a security. That's an immensely valuable transition from them not entertaining conversations and regulating by enforcement to going over and proactively going through and determining where those things fall. So I think from just a US perspective, that's a really valuable thing for us to be able to keep afoot of this, the digital era with digital assets and blockchain technology. So from an auditor's perspective, very helpful for us because one of our main questions is our client in compliance with laws and regulations? When those laws and regulations aren't clear, it's very hard to kind of get through those process, and you spend a lot of time worried about things that are not the most important, right? And you have to kind of get through those things. Now that there's more clarity, companies can operate more freely and build upon the rails. I think they're always looking to do things the right way. Maybe not everybody, but most of them are looking to do things the right way. And now they have the rails to do it, and they can kind of follow that, and we can follow suit with our procedures behind it. So it provides a lot of advantage for companies who want to access the US public markets that we have more regulatory clarity around that. I think that it's very good to see that come through and something that we've been looking for, and I think at this stage is very good.
From a regulatory perspective and talk about competition, we can look at it from the sort of the company level, but if we take it up, we look at it from the sort of the competitiveness of the United States. And I think it's really, really important because what the clarity does, it brings the bigger institutions in, not just the native cryptos, but it brings the bigger institutions in to invest in the space. And investing in the space allows our innovation and allows technology to grow and expand. I mean, historically, it's been a handful of large natives. Yep. It's been venture capital money that's been putting money into some of these early stage companies. We'd love to see TradFi and the big banks, beyond the ones that were natively in this space already, start to put money into this space and really expand software and infrastructure build. That's where it's really going to start to get adopted beyond the 90% of the people in the world that dabble in crypto, right?
From a practitioner standpoint, what do you all think they're underestimating as they're kind of going through this process and starting to look at what's being required as a part of either the Genius Act or even the SEC, CFTC collaboration that's upcoming?
In terms of what we're underestimating? Or?
Yeah.
Well, I think from a stablecoin perspective, and I'll borrow something from what Mark Andreessen just wrote about AI, and I think basically crypto right now is the killer app is trading and speculation and building technology around it. But if you look at something like AI, I think the ability to use stablecoin as a payment rail to expand AI and AI agents is like a whole nother world that is going to open up this to. So it's not just the law, but it's the fact that we have clarity around stablecoins, and then what's going to happen, so the next level of innovation and how technology is going to adopt it, I think is really where we need to be looking.
Perfect. Got a couple of kind of like lightning round questions here we can kind of go back and forth on here, and by all means pass if you don't want to answer one of them. But if integration is accelerating, what part of the ecosystem is still least prepared for what's coming?
I'll start with capital formation.
Yeah.
Tokenization as a word gets thrown around. I think it means a lot of different things to a lot of different players within that ecosystem. But true capital formation on chain can read well in a headline. I think, to Joe's point, there's going to take a little bit of time to actually figure that out. There might be some regulation for real on-chain capital formation, where you're not just mirroring that interest on a blockchain, but actually using that chain as the rail for raising funds or financing.
Right, and right now, those rails are basically parallel.
That's
They're
right.
parallel to what the existing rails are, which is creating somewhat of an inefficiency, right? And so that needs to, I don't know that those rails are gonna go, the legacy rails aren't gonna go away, but we need to sort of reinvent them to really get the value of the, you know, the efficiencies on chain.
Well, I guess people still send faxes today, right?
Yeah, true, yes. We still have that in our agreements, by the way, facsimile numbers.
What's the question you always ask in your classes? How many people here have actually written a check?
Yeah, so I always ask, I teach class at NYU, and it's related to digital assets and accounting and auditing. So I always like to ask the students, everybody in the class that's written a check in the last year versus who's used Venmo or a crypto transaction. And when I started doing it like 8 years ago, it was vastly different, right? And nobody's writing checks anymore, especially in that age class. So how about this room? Has anybody here worked with crypto? Anybody has sent a crypto payment? Yeah? How about it? Everybody here has written a check? Oh, a lot of check writers here.
I think a lot of us are writing checks today and tomorrow for the IRS. So, what's one thing that traditional finance still misunderstands about digital assets? I don't know if Sarman, you have a take on that one.
I mean, I think traditional finance still thinks that crypto is used for nefarious activity, wherein it's the worst use case for money launderers. Cash is still the best.
Yeah. Less traceable.
That's right.
We alluded to the fact that some of this is here. It's no longer experimentation. I still think it's hard for us to really wrap our head around the total addressable market for this asset class. I think it's underappreciated from a traditional finance perspective. Again, we see large US advisors saying 1% to 4% of allocation to what we know of as digital assets today. Bitcoin, Ethereum, Solana, others. That's kind of the focus. But when you take that lens and you look at structural tailwinds like 80 to 100 trillion of generational wealth transferring into the hands of people who are native blockchain users and digital asset users. When you look at the adoption of ETFs, when you look at multi-token ETF or products in market, and then you look at tokenization of real-world assets, that aperture opens up very wide, very quick. And we can talk about what's early innings or late stage and what's here, but the direction of travel seems to be a larger funnel, and I don't know if the entirety of the traditional finance system really sees how big that could be.
Yeah. And there's a lot still in TradFi that are questioning, why do we really need this? The rails work fine now. Yeah, it's a little expensive. We can save money. We can get to T0 settlements, but why? This is working just fine. Let the technology, the servers speed things up. And so, and it's fair because if you look at the ways, some of these real world assets are being tokenized, it's still very, very cumbersome. It's like you spend a lot of time and money to put together, tokenizing a real world asset or a money market fund. And it's like, well, why did you do that? Who's actually going to buy that? And where's the liquidity? And so, but I think the real answer for those that have that view is you need to be building these things now for, 3 years, 5 years, 10 years from now. But from someone looking at it now, it's like, why? This doesn't make any sense. It's inefficient. There's not a lot of people buying it. There's no liquidity. And I think that's probably the biggest issue that we're seeing in this space.
Yeah, and I think I would add on and echo what Ed said. It's one of my beliefs is that you're going to see this generational shift, where people that are going to acquire a lot of the wealth out there are going to grow up with a phone in their pocket their whole life, right? And they're going to embrace technology and things like, a car title being a piece of paper or a deed to a house, whether it's blockchain technology or something. Some technology is going to, take over a lot of the record-keeping process of things that we use today in a paper format that are going to allow those to be, borrowed against easier, sold and transacted on an easier basis, maybe fractionalized and purchased through multiple different intermediaries or different people. So I think you're going to see some evolution in the technological age as the wealth generation shifts there.
And just to add on that, I think traditional finance often finds themselves looking strictly at the token price, and as blockchains have continued to develop and integration is potentially going to come down the road with traditional financial markets, I think we'll see a trend where traditional finance starts focusing more on the real world use cases and how to value actual public blockchains in more depth.
That's a very good point. Last quick question for you all. In your respective kind of ecosystems within the digital asset space, what are you all most excited about in the next 5 years or so? I'm sorry if you want to kick this off.
I'm excited about, stable coins being used as an alternative payment rail when it comes to banking. Also excited about in the future, you're not going to have a bank account. You'll probably just have a wallet address to interact with your vendors. That's what I'm excited about.
Absolutely.
Yeah, I think very soon we'll get to a point where we stop talking about AI and crypto and blockchain, and we'll just be using this technology, and it'll just be part of our infrastructure and what we do every day. That's when we're really going to start to see it scale. Just like we don't mention a company as an internet company, someday we will not talk about a company being a crypto company.
Yeah, and I think the integration is going to be very seamless. Like you alluded to, Joe, users 10 years down the road won't know if they're using a digital wallet or not. And being able to buy crypto seamlessly and on the whim is going to be very easy. Right now, we have a lot of infrastructure gaps trying to onboard folks to the ecosystem. And so over time, I'm pretty bullish on Bitcoin and it being the proxy savings vehicle within digital asset wallets.
Yeah, I'll echo what everybody else has said. We look at it, and I said at the beginning of this that I lead the digital asset practice. Hopefully, in 5 years, that's not really a thing. It's like saying I lead the internet practice.
Right.
Well, okay, every one of our companies uses the internet, right? But we're starting to see it already. We have real estate clients looking to tokenize assets. We have a lot of companies that have transitioned a portion of their strategy into a digital asset treasury strategy. We have companies who are adopting stablecoins as some sort of payment rail. So I think you're already starting to see the intersection there, where 2-3 years ago that was not happening. It was a very segregated, thing. And today it just proves the value that what we've been building internally at CBiz as a team to service that is really on the front edge of that, and it's going to be a wider base. Everybody always looked at it as a crypto market, right? But I think that market is vastly wider than that. When you start to look at all the people or the traditional industries that may adopt that in some fashion, you're really developing a specialty that can be used across every market that you have.
So it's hard to go last to that question, given the breadth of what was covered. So I'll instead of focusing on the destination that I'm excited about, maybe I'll encapsulate what all of us have talked about. It's that education process between now and 5 years, that theoretical coming to actuality, that hypothetical infrastructure coming to now I have that. Now I'm utilizing a wallet in that framework, and we talk to financial advisors all the time on behalf of their clients and for their own education to say, I see Bitcoin, kind of understand it. I see Ethereum, I kind of understand it. But all of what we talked about has an immense amount of education, and I'm actually excited in my seat for Grayscale specifically to be that steward for people, because I do think we see it from a perch that allows that knowledge transfer, that education, and I'm actually excited about that process.
Absolutely, yeah. The knowledge gap has definitely been one of the biggest areas, especially for us at Sentry, as we're kind of educating clients or regulators or whomever. The education side is paramount for this whole process. But apologies we ran over, but thank you, Ed, Bob, Bill, Joe, and Sarman. Appreciate it. Mike, and thank you all. And we're around for questions after.
Appreciate it. Thank you.